Sanjiv Bhasin, who's joining us on the show. Good morning, Mr. Bhasin. Thanks so much for making time. Let's begin with HDFC Bank itself. There's, of course, one part of the world which believes that, the worst is priced in, the valuations are really comfortable. But then, of course, the stock has underperformed for a long time and it doesn't look like there was anything in the numbers to fire up a rally.
Yeah, good morning, Anisha. Good morning to you and all the viewers. Yeah, that was what the management guided, that, don't expect fireworks. But if you see on a sequential basis, they are amalgamating such big, large balance sheets. They are a market cap now in excess of 15 lakh crore. So obviously, it will take a few quarters of transition. But look at the CASA growth, the growth on credit, and the deposit base. I think that is telling you that they are the biggest opportunist in the whole country, and growth is very, very much on the anvil. So if you are a slightly longer term view player, then you have to invest in HDFC Bank. It is not because of the valuation or the comfort which you get and the underperformance. But remember, Anisha, there is underperformance for a limited period. I mean, who thought all the PSUs will be re-rated and double and triple? So I'm not talking of a double triple, but I think it is a portfolio pick here. And definitely you should stick to it as a SIP, because these prices may not remain forever. And if we have to go higher, HDFC Bank has to participate. So I think it is very, very reasonably in line with what the management had guided. And definitely as a disclosure, for some of our high net worth individuals, we are doing a SIP in HDFC Bank. And we think that this is a very opportune time to get into the 7th largest bank in the world.
Okay, that's the take coming in HDFC Bank. Although looking at the earnings, we may see some bottom-up buying, but maybe not to start off trade with. Kunal, what are the charts reading?
Yeah, I think at 1500 odd levels, the risk reward to enter the stock is quite lucrative. In fact, the pace of selling has stalled or halted for HDFC Bank. Yes, the stock has not participated on the days when the markets have been doing pretty well for itself. But then I think that's the nature of the stock price over the last 2-3 years. We've seen that the stock has remained more stagnant rather than more trending in terms of the price of behavior. Now, I think it requires more of a catalyst in terms of a trend to pick up or the momentum to pick up for HDFC Bank. Maybe if not result, then I think if the market gets into a breakout mode, we could probably expect that the stock may get into some sort of momentum. 1580 apparently is the nearest breakout or a resistance point for HDFC Bank. So it's been ambling into this 80 point, 100 point range around the 1500 mark to 1580 range for itself over the last, I think, couple of weeks. If we expect the stock to break past about 1580 levels, that's where we will probably hope that HDFC Bank could find or at least find its mojo back.
Okay, let's see finally when does it find its mojo back, and I stand corrected as far as the Nifty is concerned, because the implied open is suggesting that we're likely to open around that 19,800 mark. So the good handover from the global markets is something which is going to support the sentiment a bit. But Mr. Bhasin, what about the entire two-wheeler space? And let's talk about the ancillaries as well, because despite the volatility in crude prices, SIAT has managed to report a very strong expansion when it comes to their gross margins and EBITDA margins as well. Your take on SIAT and the other tire companies?
Yes, Anisha, and that is where people are, actually missing the bigger picture. I mean, in the last 1 year, Apollo, SIAT, MRF, they more than doubled on the back that SPT rubber prices have softened, China's imports have almost vanished, and locally, if cars are at a 1-year waiting, then the ancillaries have to do well. So you name it, from a Bosch to a Motherson Sumi to a SIAT, which I think the margins are actually superb, but it's also in the price. The stocks are not cheap and they've doubled or tripled. But it's telling you that OEMs are in a very sweet spot. And as long as this Chinese embargo remains, I think we are, most of these companies will do extremely well. Now, of course, like we said, it was 850, 900 at 2000. The comfort of price may not be there. And you may see profit booking because good results are already priced in. But I still think that fundamentally autos are in a very sweet spot. So Maruti, Ashok Leyland, Tata Motors, Hero Moto, Bajaj Auto, these all seem to be in a very sweet spot, and you should be looking for declines. On the OEM, like you said, our top pick continues to be Bosch. We are very, very bullish on the likes of Exide, where the two, it's a duopoly, Exide and Amar Raja, they are gaining more and more traction. And with lead and nickel prices falling, their net margins can be very, very strong.
Sanjiv, the first earnings from Jio Financials, what's been your read-through?
So, good morning. Aisha, it will take time. Jio has just been initiated. It is going to be an outperformer. And you know the mutual fund distribution, the whole gamut of cross-selling is picking up well. And it's got the brand behind it. The stock is an expensive stock. But if you have a 2-year vision, that like I said, you must add HDFC Bank and Jio purely on the back of pedigree managements and the way forward. India is on the cusp of savings being capitalized onto stock market and other instruments, and that financialization is going to be widespread, and the bigger players are definitely going to get the largest share of the cake. But make no mistake, the NBFCs are being an outperformer, and I think that their cost of funds and their diligence compliances are much less than what banks have to do. So Geo is in a sweet spot, only it needs more gestation.
Okay, fair enough. Mr. Bhasin, you were earlier quite positive on the likes of Tech Mahindra, Persistent when it comes to the IT pack. Any other name that you like? Especially HCL Tech has been seeing quite a bit of buying from institutional investors. Your take?
Yeah, so Anisha, you took two names, but HCL Tech was top of them as a disclosure. HCL Tech, Tech Mahindra, and Persistent continue to be our three top names. We've added Coforge because we think there is no promoter and it could be a very, very sweet, candidate for some infusion by a large player. But HCL Tech is a no-brainer. I think 1500 is coming by the next year, and that has been the best performing stock, but purely on the back of rise in margins. And it trades at still half the multiple of a TCS. So HCL Tech, Tech Mahindra, and Persistent in that phase, and you can add a Coforge around these levels.
Okay. Kunal, is the worst behind for IT, or is it too soon to say that and one should be stock specific?
I think the worst is definitely behind the IT, at least looking at the price movement. That doesn't mean that the prices would start to rally immediately. I think these stocks may consolidate a bit more. I think larger cap stocks like TCS, Infosys, looking at the last 2 days of charts, the first gap down for these stocks and then a mild pickup of price action, slight resistance at the 50-day moving average. There could be slight bit of more selling which could be due for these larger cap IT names. But then when I look at this in the comparison with September 2022 lows, where the stocks were TCS up 3000, Infosys around 1200 mark, I think they are significantly above those major lows for themselves. So I don't expect these stocks to create a fresh low unless there is something completely negative which happens across the globe or for the sector specific. But I think purely looking at the charts in the recent play, I think the worst part for the IT stocks is behind us.
Okay, point taken. But of course, apart from the entire movements that we are seeing in the stock prices, there's a lot of volatility when it comes to the crude prices as well. And as a result of that, the gross refining margins, at least the Singapore GRMs that we track very closely, seem to have crashed. What's the implication back home? Somit is joining us with all of that.
Well, all the oil refiners would remain in focus, that is MRPL, Chennai Petroleum, Indian Oil Corporation, BPCL, HPCL and Reliance Industries. And this is because of the fact that Singapore gross refining margin, which is the Asian benchmark for GRMs, has fallen to around $4 per barrel. Now, the margins are lowest since July 7th. And if you see from the recent peak that we have seen on August 28th of close to $15.4 per barrel, the margins have fallen by nearly 74%. Now, this is because all product prices were down, and the drop in margins could be owing to higher Chinese exports of refined products, Russia easing the fuel export ban, and because of higher refined product inventory in the US market. Now, how does it impact the oil refiners? Now, generally, a $1 per barrel drop in gross refining margin impacts MRPL annual EBITDA by around 1,000 odd crore rupees. For Chennai Petro, it lowers their EPS by around 30 odd %. For Indian Oil Corporation, BPCL, HPCL, it decreases their EPS by around 14 to 16%. And for Reliance Industries, their consolidated earnings come down by around 4 to 5% with every $1 per barrel drop in the gross refining margins.
Okay, that's the take coming in on what the GRM uptick would actually mean for OMCs and other oil companies as well. In the meantime, let's just look at the trading texture for yesterday. While Hero MotoCorp had a field day yesterday, you had some of the metal names as well come to the fore. Coal India continues to be on an uptick, and that was the case pretty much with an ONGC, and then Axis Bank as well held out. It was a better day, of course, for the broader end of the market, where names like a GNFC, MCX, NMDC, Motherson Sumi, and Aditya Birla Fashions made a dash up in the green. Sanjeev, just wanted to understand, as a strategy, are you stock specific, or is there some market cap categorization as well, wherein the tilt is more towards small and mid caps other than large caps, or vice versa?
So Aisha, actually it's the momentum. And we will keep talking about the rise in yields and so on. But the local flows are now definitely looking towards mid caps and the small caps. And that is why you've seen PSUs, fertilizer and chemical Travancore has hit an all-time high. This stock used to be 30, 35 about 3 years back, and nobody wanted to touch it. Same is the case with REC, PFC and NMDC. It's been a star. So it's telling you that ground level iron ore is definitely going to be in demand, and this chaos will see commodities do well. So like I said, it's the broader market which is outperforming and making money. Hence, when you see declines, these are the ones which come back very, very fast. Can it continue? There is still a lot of valuation comfort now in large caps. And I would feel that Reliance and HDFC Bank, now with pricing in most of the, lukewarm earnings or the prospect of some of the repatriation, they would start to shine. So we have an overweight on Reliance. We think that GRMs, just the sum of part of $10 billion as a valuation for retail, then the rest of the business cannot be at less than 6 lakh crore. And I think that is giving you a chance to get in. We also are very, very bullish on metals, because we think the undoing of a lot of the geopolitical risk will see a rise in copper and aluminium. And we think steel prices, there is already talk of an 8% rise in the price of steel locally. That could actually give an impetus to the likes of Tata Steel, Hindalco, which are, part of the index.
Sure, point taken. In fact, let me quickly bring in Naresh as well into the conversation. Naresh, your take on Reliance Industries and, of course, Bajaj Finance, which will come out with its earnings today?
So Reliance has been pretty sideways for quite some time now. So out here, the view is one needs to wait for more price action to see a change of trend. So as of now, we are still stuck at that 2300, 2350 band for the last 3 sessions. For the last 2 weeks, 2300 to 2400. So once we cross 2400, that's the time where we call a short-term reversal. For now, it is more a sideways stock. Same is the case with the HDFC Bank. So very similar for these two heavyweights. Bajaj Finance, on the other hand, has an interesting chart formation. So if you look at Bajaj Finance today, now it closes to 8,000 rupees. The stock was close to 8,000 in July of this year, as well as in, say, October of 2022, came closer to 7,800. And it had peaked out in September to December of 2021 around the 7,800 to 8,000 mark. So it's on track for a breakout going forward. I would expect it to hold 7,700, 7,800 in terms of a reaction to results as such. But structurally, 4 to 5 attempts made around that 8,000 mark. So generally, a resistance gives a breakout after 4 to 5 knocks. So it's been done out here. So I would expect slowly and steadily the stock could actually go towards 8,600 to 9,000 mark.
Okay, that's the take coming in on Bajaj Finance. In fact, on that note, let me take it across to Vamakshi and find out what to pencil in for Bajaj Finance's numbers and what to look out for.
Well, yes, but before we get started for Bajaj Finance, it is important to take note of the results that came in for its housing finance subsidiary, that is Bajaj Housing Finance. Yes, the loan growth was strong at nearly 29% on a year-on-year basis, but the net interest margins have actually seen a contraction of almost 12 basis points on a year-on-year basis, and that was mainly on account of higher borrowing costs. The net profit, however, declined, and that was mainly on account of normalization of taxation. But nevertheless, when we look at the GNPA, that has actually seen a marginal hike of almost 23 basis points on a sequential basis. Now, moving on to the expectations for Bajaj Finance, in the second quarter, we did see the company post an AUM growth of almost 33% on a year-on-year basis. But given the pressure that is expected to come in on the margins front, we are expecting net interest income to grow at nearly 29% on a year-on-year basis, standing at 7,130 odd crores. PPOP, that is pre-provisioning operating profit, given better cost efficiencies, is also expected to see a growth of almost 31% on a year-on-year basis, coming in at 5,850 odd crores. Now moving on to the net profit, that is seeing an uptick of almost 28% on a year-on-year basis, standing at 3,550 odd crores. Now largely, yes, the margins are expected to be under pressure, mainly on account of rising cost of funds. In fact, in the first quarter, the management had indicated that they were expecting nearly 10 to 15 basis points of compression in the next 2 quarters. GNPAs are expected to be more or less stable. In fact, when we look at the GNPAs, they were at the lowest level in the company's history in the first quarter. Credit costs are also expected to remain stable for Bajaj Finance. Apart from that, when the con call happens later this evening, we will be keeping an eye out on the kind of commentary that comes in with regard to its growth prospects, the customer addition trajectory as well. It will also be important to monitor some of the commentary that is around the fundraise that the company had approved very recently. Apart from that, commentary on the asset quality, given the challenges on the unsecured portfolio, will also be another important factor to watch out for. So all in all, a steady, strong quarter is expected from Bajaj Finance this time around.
Okay, shifting focus now to the other two bigwigs from the entire financial services space, and that's HDFC Bank as well as ICICI Bank. A bit of divergent move this year, Nikunj, while ICICI Bank is up almost 6-7%, HDFC Bank has been the massive underperformer, down 6 to 7% for the year so far. Do you think that's likely to reverse?
Sinisha, before we understand next 3 years, let's take the last 3 years for HDFC Bank, the pre-merger. Post the Chanda Kochar episode, the HDFC Bank was here and ICICI Bank was here. Now the situation pretty much has reversed, both in terms of outperformance and in terms of opinion. ICICI Bank has come here and HDFC Bank has come down here. There is a very simple matrix in which you look at banks, and I'm going to break it for our viewers. It's price to book and then P multiples. On both account, ICICI Bank now is actually more expensive than HDFC Bank or vice versa. There you go. This is a forward. I don't remember when was the last time this happened. Now, for me, this in a sense is a very important graphic which tells you the story of how the market positioning has changed. Markets in the near term will always reward performance. And the performance has been lacking with HDFC Bank largely because of the merger issues. For ICICI Bank, they're firing full cylinders, and it's been one of the massive turnaround stories of the banking sector per se. But this kind of a discount, I think, is something which is a rarity. Now in 2015, we saw a similar equation where ICICI Bank had almost gone to levels of SBI in terms of the banking business valuation. But if you bought that time, you had comfort of margin of safety and you had comfort of a turnaround. With HDFC Bank, I think it's not turnaround, but I think it is continuity which would be there and attractive valuations. And I don't think, looking at the news flow, anything substantial could go wrong from here. And most of the negative surprises are out. So if you have so my sense is that if you have to choose now between ICICI Bank and HDFC Bank, the vote goes for HDFC Bank. Underperformance, attractive valuations, unlikely negative communication, looking at what our understanding of the business is. And pure weightage in the Nifty is something which cannot be ignored for long, because now it's about 14% weightage. How long? If you're bullish on India, you cannot be bearish on HDFC Bank. Let me put it this way.
Oh, well, yes, that's a key takeaway. If the index has to move, and if you're bullish on India, of course, HDFC Bank is a critical part of that journey. So have to be positive on that. And right now, the preference seems to be tilting more towards HDFC Bank versus ICICI Bank.
Right. In fact, Sanjiv, we know your views on HDFC Bank, but if you were to stack up HDFC versus ICICI Bank, you think the risk reward clearly is tilted towards HDFC Bank, given that ICICI Bank already has been a performer?
Well, yeah, that's what the market is all about, rewarding outperformance. And like Nikunj put it, if you want a weight, if you are looking at bullish part of the India market and going back to 20,000, which I'm very sure is coming in the month of October, then HDFC has to perform. Now, ICICI has definitely been a huge outperformer in the banking. But what, Aisha, I would suggest buy the Bank Nifty Bs, because the Bank Nifty has 6 PSUs and 6 private banks. And if you want to catch a basket, then you're buying HDFC, ICICI and the other top bank. Actually, Bank Nifty can be an outperformer. It has been a relative slight underperformer in the recent 1 month, but I would look at that outperformance. So I don't want to let go of ICICI, but I want to also add HDFC Bank, simply because I think ICICI is headed into 4 figures and beyond, and HDFC will follow suit because of the valuation comfort.
Okay. Buy both. That's the call coming in from Sanjiv. In fact, buy the Nifty Bank Bs is what he's suggesting. The other one, of course, and pretty much like an HDFC Bank story, right? Avenue Supermart, Sanjiv, the going doesn't seem to be that great, at least the past few quarters. And this quarter as well, the net profit slipped 9%. The store additions have remained muted. But do you think, it's all baked in the price now for Avenue?
Correct. And Aisha, like I said, the stock has been a relative underperformer after a huge bout of outperformance when it got listed and so on. And it set the cat amongst the pigeons that what is the extent of retail participation and retail growth which India can visualize. Gone are the days of Kirana stores, and you can see that across the board, these type of supermarts are, raking in the customers and footfalls. I think the branch consolidation and the footfalls and the new acquisitions may take some time to plateau, and you could see margins come back. But arguably, I think the next 6 months could arguably be one of the best for consumption. And if we see a plateauing of geopolitical risk, because this is a recession-proof industry, I think this will again regain its mojo. But like we said, the trends and some of the other supermarts, particularly Jio Retail, Reliance Retail is doing extremely well. So I would, sum of parts, still buy a Reliance over Avenue Supermart.
The P multiple is where you would say that, look, you don't make too much of money if you buy stocks actually at P multiples of 70, 80 plus. Let's look at some of those stocks. If I may use the word expensive P multiple stocks, महंगे share, Asian Paints 2-year move or 3-year move. Actually, 2-year move is more apt for it because 3 years makes it that you'll have to include the COVID swing also. But let's say if you take the 2-year move in Asian Paints, flat. 2-year move in Pidilite, flat. 2-year move in Nestle should be flat. 2-year move in HUL, absolutely flat. Some of these stocks have not, Nestle is 25%, but for me it's underperformance because remember in 2021, you're coming from that COVID bounce. So including that COVID bounce, HUL has given you actually returns which are not even in line with Nifty. Now the same time frame, let's look at Nifty. You need to compare like to like. So let's also compare the 2-year move from the same. Wow. So all the FMCG stocks, with the exception of ITC, have underperformed the Nifty. भसीन साहब ऐसा क्यों हो रहा है?
वो इसलिए है निकुंज जी, आपने दो नाम बोलता हूं जो मैंने स्वॉट किए थे और वो आउट परफॉर्म किया, आईटीसी एक है और गोदरेज कंज्यूमर. But Nikunj, why are you saying that? Because you've seen the big outperformance of mid caps and PSUs, and if money had to go there, then risk had to shift from flat or less beta industry like an FMCG, an expensive industry, into the likes of the PSUs, and still they are under-owned. That is why we compare like to like with the PSU basket or the broader mid-cap market. Then these stocks have definitely been a laggard. But that's the beauty of the market. There is enough on the plate for investors, and if you have the long-term vision, then these stocks are created by brand value over years. Nestle, by the way, has given, I think, over 20%, 25%, but it would be one of the best outperformers. 17,000 is close to 24,000, and there is talk of a split and so on. So I think definitely this basket is looking good, and you will have to ignore one more quarter of maybe flat earnings to slightly moderate, but the longer term trend looks good. And in comparison, Nikunj, they are definitely underperformers with the broader market.
Right. Okay, and I wouldn't be surprised if there's as much trivia that comes out if we stack up what the two-wheeler names, Nikunj, for instance, have done. Look at that. Hero MotoCorp, Bajaj Auto. Nothing on Hero Moto.
I mean, just think about it. Hero MotoCorp in last 2 years has given you no return.
Yeah.
Now, the best part, I think, is yet to come. Let's look at TVS in last 2 years. And
no, before that, Bajaj Auto, 45% move, and I think the large part of the move has come in this year.
This year, because exports in a sense have come back. But if Nifty is given 40%, Bajaj Auto is giving you 45%, that's okay. It's not been an exceptional outperformer when it comes to the Nifty. But guys, look at TVS. Hello. 226% for TVS. And that similar time, if you look at Bajaj or Hero MotoCorp, I mean, there is just no return whatsoever. Since we are talking, let's look, Eicher also dekh lete hain. I don't remember the numbers, but let's look at Eicher also. It must have not done that bad because, this whole cult motorbiking category, Eicher has actually done worse than Bajaj Auto. So you live and learn. It's a new, I thought Eicher must have done better. Now let's do Maruti and Tata Motors. And that's where the surprise would come in, my friends. I think that's where the mega surprise should come in, because Tata Motors, where it was at the peak of COVID crisis versus now, look at the difference. Tata Motors all the way. I think Mahindra and Tata Motors, I don't know which one. I think it should be Tata Motors, right? 2 years? I'll have to
In
guess.
2 years, Eminem has had like, I don't know, let's just bring up that chart.
I don't know.
Maybe Eminem, I don't know.
Let's see.
I don't know.
Patricia?
Kunal would know better in the last 2 years what's performed better.
No, Tata Motors.
Oh my God. Okay,
Tata
yeah.
Motors.
Yeah, actually, for Eminem, I think it's the the post-COVID recovery, which was steeper. Maybe in the last 2 years, it's actually Tata Motors.
So if you stack up
57%.
Yeah, I mean, so how can you take a sectoral view now? I mean, it is getting so stock specific. Imagine you bought India's biggest auto company, thinking that COVID has normalized and people will start going back. You've made no returns. You bought a bet on EV, TVS, you've hit out of the park. You bought Tata Motors, which in a sense was almost going through an existential crisis at peak of COVID because of its debt, has given the most fantastic returns. And Maruti, which was the market leader, has actually given you no returns. So,
Yeah.
very
It's the
interesting.
T factor. Tata Motors from PVs and TVS Motors from the two-wheelers. Sanjiv, what are you placing your bets on? Who's going to win the race in the next 2 years?
Ashok Leyland. And I think Ashok Leyland has been a stellar outperformer, but not as much as what Tata Motor and Mahindra did. Aisha, look, Tata Motor was doing nothing till the beginning of this year. It is just this last 6-8 months that it has really spearheaded itself, all on the back of N. Chandra's philosophy, outlook, and the accent of EVs. But I think Ashok Leyland is very well poised, given that it's in defense. You travel by Indigo, all the blue buses are Ashok Leyland. You would see their ICE, the intermediate commercial vehicle, that is Ashok Leyland. And they are gaining more market share in the passenger vehicle. As a disclosure, Ashok Leyland has been in my portfolio since, I think, over 15 years. And I still think that given the depth of the portfolio which they have, they can be a real outperformer. But like you pointed out, it has been TVS, it has been Bajaj, it has been M&M, and it has been Tata Motors which have taken the cake. I still think Ashok Leyland can be a huge, beneficiary of all these underlying businesses, infrastructure related, which are doing very, very well.
Sanjiv, on that note, we'll let you go. Ashok Leyland, we will track those charts.